Welcome back, everyone. On today's video, we will be discussing CNR. It's a company that I currently own in my portfolio, and I'm sure a lot of you have this one as well, as it is a dividend growth powerhouse. It trades under ticker symbol CNR here on the Canadian side and ticker symbol CNI on the US side. Now, it has a very, very small yield at the moment, but I mean, like I said earlier, it's a grower, not a shower. It's paying just above 2% currently. And if we look at the year chart, it's done not too much over the past year for a good reason due to the economy. However, I think right now presents a pretty decent time to open a position. In my opinion, if anyone has been waiting on the side of the fence here for a good entering price, I just recently added to my position in the $148 and change range myself. One thing I do want to talk about is the PE on the stock. It is 19, which is pretty high here for a railroad. And as you can see, if you look at the stock analysis by the analysts, a lot of them have it as a hold. This is the reason they think it's overpriced, especially with the economy going down. I get it, but this stock has really never been cheap. And if you look at it on a 5-year chart, that's a pretty slow and decent growth looking type thing. If we hit the max, obviously it's going to go up and to the right. And this is what you're essentially going to get. Well, it's what you're hoping for if you own it for the long term. But, all railroads have quite a moat in Canada and America because you can't just put down new rails and build a new track wherever you want. There's houses, there's infrastructure, everything is in the way. So basically, you can't make meaningful new railroads. You can put tiny little things here and there, sure, but if you want a cross-country behemoth, you have CNR and you have CP in Canada. That's it, guys. So, I mean, they're both good to hold, but I own both, but my bigger position is in CNR, and that's because I'm a dividend growth investor, and I like the balance we get because we get the 2% yield, but we get the huge dividend increases going for, well, not huge, but good, healthy, hearty dividend increases going forward. CP, they're not always a dividend raiser, but they have some other good things going for them. We'll get into that on another video. Up on the screen here, I have the past couple years of dividend increases for CNR. And as we can see here, they most recently raised 7.85%. Previous to that, however, is 19%. That's what I'm talking about. That gets me pretty excited. Previous to that is just under 7%. So as we can see, even if we take out the 19, if we get 7% dividend increases going forward, I mean, that's really, really good. Management has mentioned that they're looking in that 6 to 8% range, and they confirmed that guidance for this year. So it's not time for a dividend raise quite yet. It's usually every fourth quarter. So 1, 2, 3, 4. It's coming up real soon, and hopefully we get an announcement about that, and all of us shareholders can get excited. And just to touch about what I was saying earlier, how you can't just build new railroads because there's things in the way, and it's, the costs associated with it are ridiculous. Take a look here on the map. You can see we're going from Canada's west to the east all the way down to the south. This is a beautiful, beautiful thing. Can't really be replicated, and this is where the moat lies. Railroads have some of the best moats in any business across the board, in my opinion, just because of this exact issue. So it's something to keep in mind if you're thinking about buying the stock. You're not going to get explosive growth, but what you are getting is something that cannot be replicated in today's day and age. Some of you might be thinking, Elon Musk just invented some fully electric trucks. Pepsi's leasing them. Yeah, that's all true. Fully electric trucks are not going to take the railroad out of business. It is another good, in quotations, environmentally friendly way to transport things. But these two things can work in conjunction with one another, and one is not always going to be better than the other in certain distances. So they're all going to have their advantages. They can all work together. It's not an all or nothing equation. So like I said, yeah, new tech's going to happen, but this old slow and steady way of moving products, not going away. I'm just going to quickly touch on a couple of the numbers. You guys can go into the more current 2023 things. I just have their annual investor presentation up here. And as we can see, the earnings per share from 2018 to 2022 has a 6% CAGR. That's good. It's not great. But like I said, this is a slow growth type of company. This is fine with me. I like it. Net income CAGR 4%. Diluted earnings per share, CAGR 8. Free cash flow, very important for us dividend investors, CAGR 14%. So that's great, but I will put a caveat on all these good-looking numbers, guys, and that is that the economy is going poorly now. Obviously, we're entering a recession by all accounts, so these numbers aren't going to go super well for a little bit of time, and then I'm sure they'll continue back up. Well, hopefully, I shouldn't say that, I'm sure. As you can see, from 2019 to 2020, there's dips. That's the type of thing we're going to see in the coming years. So, I mean, I'm not the best at timing share prices, as the followers of the channel know. I kind of mistimed TELUS, but I don't really regret buying it. I just wish I waited for a better price. It's a great company. Maybe I bought in at the wrong price now on CN, but I think it looks good going forward. You guys let me know what you think, if you're waiting for a lower price, if you love it or if you hate it. But thanks for watching. Like and subscribe. We'll see you in the next video, guys.